Saurabh, good having you. Thanks so much for joining in. Just a word on the markets firstly. The last time that we spoke to you about 8,500, 8,400, you were talking about how the policy translation is not happening as per the desired pace. You were negative on the markets. The markets have gone down a bit, have climbed back a bit the last couple of sessions as well. What are the thoughts right now? Is the consensus trade still on the downside because of all that's happening around us?
I think our thoughts remain broadly what they've been over the last 5-6 months, Nikunj, that the economy continues to soften as we see it. I'm not so sure rate transmission is happening even this time either. We've heard that SBI is not going to transfer any more than 20 bips of the RBI base rate cuts of 50 bips from last week. And I think that picture that we've seen over the last 8-9 months, that barring HDFC Bank, no other bank really has the balance sheet strength at the moment. Amongst the larger banks, that is, no other bank barring HDFC Bank really has the ability to pass on base rate cuts to its customers. So I think rate transmission clearly isn't happening even this time around either. The real estate market continues to crumble away. I haven't seen any signs of the capex cycle turning, barring a few projects here and there, and hence the overall picture of a sluggish economy continues to hold true. Now the good news lies in the fact that our equity mutual fund clients continue to see positive inflows, and that is in some measure able to counteract the negative FII outflows. I reckon FII outflows will continue for some months, but the good news is that the domestic mutual funds are being able to counteract that and hence exert some measure of stability to the market. But overall, our sense remains that with the economy continuing to slide, I think there is still remains significant downside in this stock market.
Saurabh, hi, morning. So does that mean you're sticking by with your fiscal year-end target for the Nifty, or are you changing that now?
Yeah. So what we've been saying for a few months now that if you look at fair value for the Sensex for FY16 end, that is around 28,000. So on a rational basis, if I were to use a 10-year trailing earnings multiple of somewhere around 17 times, then fair value for the Sensex at the year end is around 28,000. That would suggest a modest amount of upside between 26,600 where we are today till 28,000. However, as I've been repeatedly highlighting, we are entering a set of circumstances, both global and more importantly local, a set of circumstances where fear could become a critical driver of stock prices. And in that sort of fear-ridden scenario, Sensex 22,000 also remains, I think, a highly likely possibility. So whilst there is a little bit of upside on a fair value basis, 28,000 on the Sensex at March end, I think Sensex 22,000 is a scenario that I would suggest investors have in their mind, given the degree of pain around us, pain in the macroeconomy, pain in the banking system, pain in the real estate sector, and increasingly evident that there is a degree of pain even in the money market. So we remain circumspect about Indian equities, and our suggestion to clients is to reduce exposure to cyclicals, focus on high quality, well-run companies, strong cash flows, high quality corporate governance.
The fact, Saurabh, that US 10-year paper has gone below 2%, that psychologically in the short term could be an advantage for emerging markets. In India, interest rates have come down by 50 bips. Transmission now seems to be evident. So are you undermining the importance of these two factors?
I think a couple of points to reckon with. I don't see the transmission happening. As I just said a few minutes ago, it's not evident to me that the banks are rushing out to cut rates by 50 bips post the governor's rate cut from last week. And secondly, even if the banks were looking to cut their base rates aggressively, even if the banks were looking to do so, it's not evident to me that corporate credit demand and hence a recovery in the corporate credit cycle is around the corner. So the domestic economy picture looks reasonably clear, and it continues to look fairly downbeat as it has done for the last 6 months or so. Going on to global factors, the main point of view that I keep seeing both in the flows that we see in Ambit and more generally when I read the global press, is that you're seeing emerging markets shut down, emerging markets funds shut down at a rapid clip. I think for the first time in 10 years, for the first time in 10 years. This year we've seen more EM funds shut down than have been opened. India remains an overweight inside most GEMS funds, inside most global emerging market funds. We are an overweight, and hence if GEM funds continue to shut down at this rate, obviously we'll continue to see our share of outflows. So just focusing on the two facts that we have sort of greatest grip on, one is our own economy, capex cycle, bank transmission, not a particularly pretty story, and then the EM fund outflow story, which I think will continue to work its way through the next few months.
Now, Saurabh, in terms of regime, what will change for India at a macro level is that interest rates surely will come down. Inflation is no longer a risk. In last 4 or 5 years, we've looked at a different regime where interest rates have gone up and inflation has been a structural issue. So with the assumption that rates will come down, inflation is not an issue, how will the market behavior change?
I think that's absolutely the crux of what will ultimately drive the turnaround in the economy. You're absolutely right that that rates will continue falling. Our reckoning is before the fiscal year end we'll see another 25 bips rate cut, and I think the path to salvation for the Indian economy over the next 12 to 24 months is highly likely to be around a deeper drop in rates, followed by a more affordable housing market. But I think we need to get that housing market to become affordable. I don't yet believe that affordability in our top 10 cities in our housing market is there yet. I think we'll need a further price correction in Indian real estate. If I look at most of these real estate websites, we've corrected by somewhere between 10 to 20% in terms of house prices. I reckon we'll correct by at least as much over the next 12 to 24 months. A combination of cheaper housing, lower interest rates, I think is the most likely driver of a pickup in our country. I can't see the corporate capex cycle coming through given the overcapacity we have in so many sectors. So the consumer is the most likely source of a revival. But it'll take a while coming. I don't see this revival coming this fiscal. It's more likely to be a story which begins somewhere around summer next year, and hence a bottoming out of the stock market somewhere in this winter, bottoming out of the stock market sometime this winter, and an economic pick up next summer, I think is the most likely sequence in which we'll go. Look at it another way. We are likely to gravitate from a regime in our country where the retail investor focused on physical assets, gold and real estate. Now the retail investor will increasingly focus on financial assets. That's good news for the Indian stock market over the long run, good news for the Indian banking system. But as we move from that old system of physical to a new system of financial assets, real estate is an obvious casualty, and hence we'll see further downside in real estate before the economy starts bottoming out. But you're absolutely right. Lower rates via which the housing market revives sometime next year, I think is the most likely route to redemption for the Indian economy.
Saurabh, it's interesting to note that 3 quarters of a caution on the quarter hasn't wavered your confidence in HCL Technologies. What do you make of the caution that they sounded ahead of this quarter's earnings as well? And why is this becoming a pattern? Also, secondly, somebody made a valid point. They've mentioned about currency-related issues this quarter. If anything, the currency movement should have augured well for IT companies by and large this quarter.
So clearly, there's no denying the fact that when a company keeps warning quarter after quarter, it's not a happy story. But that being said, what we continue to like about HCL Tech is this is the company which I think has made the greatest effort over the last 3-4 years to move away from the traditional Indian IT model of application development maintenance into the more growing markets of remote infrastructure management, and then over the last 2 to 3 years of engineering services. Alone amongst the frontline IT stocks, this is a company where the bulk of the revenue, something like 60% of the revenues, either comes from RIMS or from engineering services. And furthermore, the fact that they're willing to be fairly candid ahead of results, they're giving you a warning about the currency movements, I find that at least reassuring. Where I continue to stick to my guns on HCL Tech is that underlying shift in the business that they're making to RIMS, to engineering services, I think will bear fruit. We've already seen signs of that. If you look at the new business wins in the previous announced in the previous set of results, in Q1 results, that the greatest amount of new business wins amongst the frontline IT stocks. And typically, if you take HCL Tech's profile, the quarter in which they have new business wins, in subsequent quarters, the business gradually comes through. Basically, you sign up the contract, you take upfront costs associated with the contract, and then over the course of time, the revenues flow through. So my reckoning is that pattern will bear out this time as well. And you know, one of the pillars of our franchise has been the willingness to focus on sustainable competitive advantages of a company rather than focus on the quarter-to-quarter movements. On that basis, I think this is one of the few frontline IT stocks alongside TCS which has been able to build something akin to sustainable competitive advantages in what is a brutally competitive business.
Sort of low inflation also means that companies will not have a lot of pricing power. And indirectly, in a low inflation scenario, do you think consumers may not do well? You know, whereas conventional wisdom is that low inflation means more space, more savings and more spending. But I'm looking at the other equation, which is low inflation means no pricing power for some of the consumer names.
Yes, so I think on consumer names, I think discretionary spending, I'm not yet convinced is back in urban India. The space where we are looking a little with much greater focus is the FMCG space, because what's been very evident from the government is that over the last couple of months, several key members of the government have made positive noises about DBT, direct benefit transfer. And what I think will happen over the next couple of years is the government will show a fairly strong desire to pump large amounts of money directly into the accounts of below poverty line people. So whether it's the PDS scheme, which rather than giving food in kind, the government will start giving food in cash, or whether it's power subsidies, I think there's a great desire on this government's part, it would appear, to give direct benefits into the bank accounts of poor people. That obviously could translate into upside for the FMCG stocks, and that's an area where we are looking at more keenly. And my contrarian bet is that it could well be that staples surprises us more than discretionary consumption over the next couple of years. I know that the consensus view is, hey, discretionary consumption, urban consumption will come to the party, but it could well be that staples surprises us more than discretionary.
Saurabh, always good chatting with you. Thanks much for taking the time out and sharing with us your market opinion.
Thank you. Thanks a lot.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.